So what I found is, statistically speaking, the number one most important thing is always going to be overextension to the upside. So how much did it move to the upside and how quickly it moved to the upside? And this is 2025. So, going back every year, the charts look just about the same. And these are the results. Started with 80,000 and ended with 386. Which is a 382% return. All short trades, 0 losing months. That's what I look for, is how much can this move in the pre-market and after hours in low liquidity. The day before, during regular session, it was already overextended. That's even better. It's best to find something that moved big pre-market or after hours or in some condition of extreme low liquidity, because when the liquidity comes back in, they just die. The largest drawdown was 38,000 or 41%, which unfortunately that happened in January, right at the beginning of the year, so that beat down the account quite a bit. This doesn't affect me so much when it's later in the year, but due to the compounding strategy that I employ, it kind of beats you up a little bit when it happens in the beginning of the year. And this is the biggest gap that I think I've seen in my trading career from a LUDP halt. We were at, looks like 65 all the way up to over 100. So it almost doubled in one gap from one limit up, limit down halt. When this happens, you can expect they're probably going to try and do it on that spike, and they're probably going to try and do it right at the market open when the liquidity is the highest. So this was a fantastic trade. This was actually the largest trade. I think this was that 29,000 trade in the USIC account. Be a contrarian. We were talking earlier about when your friend texts you that they're excited about the markets, that's when you should be looking the opposite direction. So kind of try and look at things a little bit differently than the general consensus. I think that's really important.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. This helps us out in two ways. First, it lets YouTube know that this is a valuable resource and it'll push it to a wider audience of traders. And two, it allows us to reach out to bigger and better guests in the future. So thank you so much for your support in advance. Also, go ahead and click the like button if you haven't already. And if you have any suggestions for traders you'd like us to bring on the show, also let us know down below in the comment section. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This episode is powered by public.com. To learn more, visit the link down below in the description. Joining us today is someone I'm really excited to talk with, Rajnus of Rajnus Capital, who is a day trader and returned 382% in the 2025 US Investing Championship. Amazing performance. And today we're going to dive into his background, systematic edges, backtesting, and key trades from his high performance year. So really excited for this one, dive into the nuts and bolts. So Ty, thank you so much for your time. Appreciate you being here. And yeah, excited. How's it going? Welcome.
It's going great. Thanks for having me, Richard. It's good to be here. And for anybody who's interested in short selling or might possibly want to become a better short seller, that's all I do. So you'll probably get something from this. And likewise with systematic trading, anybody who's a discretionary trader and wants to get a little bit more into the systematic side of things, you'll probably get something out of this too. So it's great to be here. Thanks for having me.
Yeah, and the short side is something that I personally need to up my game on. So I'm looking forward to taking some notes on this one, Ty. So perfect. To start things off, and I know you prepared some great slides for us as well, kind of breaking down your process. So feel free to share those whenever. But take us back to the very start. How did you first get interested in the markets, trading, and kind of develop your process over time?
Yeah, so I started in 2019, and basically, I was going to college at that time, and I was financially in one of those places where you're spending a lot of money on college, but you're not making any back. And, I remember one day my granddad, he came over to the house, and we were talking a little bit, and he said, "You know what, Ty? I want to help you. I want to give you $2,000 to get you started in investing." And I didn't have a clue about investing, absolutely not a clue. But I thought this is a good opportunity, so I'm going to get started. So what I ended up doing, I started an E-Trade account, and I think I bought the most random stuff you can think of. I mean, I bought Costco, I bought Walmart, I bought maybe an index, ExxonMobil, just random stuff. And in a year, I made $12. And basically, I decided this is not for me. So I wanted to figure out something else, some way to have higher returns, because it piqued my interest. And from there, it just kept going. But really, I owe my start to Granddad coming over and saying, "Hey, you need to invest, so get started."
That's great. And had he been doing that for quite some time? And did he teach you anything, or is just like here's a starting stake, do what you want? Yeah.
Yeah, no, he's old school, so I'm not sure who his advisor was, but he had an investment advisor, and he suggested maybe I go to Edward Jones or something like that, and you make 6 or 7% a year or something with those guys. But I figured I would just start an E-Trade account and just get the ball rolling there. But he didn't provide any advice or anything like that. He just said, "Get started."
Well, I mean, that's how everybody starts. So it's good to hear. From there, so how did you go ahead and you wanted higher returns? What were some of the resources you turned to and the strategies that I'm sure you tried along the way?
Yeah. Well, I remember I was at a job fair in college, and one of the companies there was a company called Nevada Copper. I went to college in Reno, and this company, we were looking at possibly doing an internship, and this company basically went bankrupt eventually. But it was a penny stock at the time, and I looked at the stock and I thought, man, that's a fascinating chart, how volatile it is. You can get in, 100% up, 100% down. Eventually it delisted, but I was just fascinated by the OTC land, over the counter. Right. And penny stocks. So that kind of got me interested in the OTCs and the penny stocks. I wanted higher returns, and small caps, nano caps, micro caps. This is where it was at for me. So I really started to focus there.
So that's where the movement was from the start. Were you short side minded, or
no? No, I had the mindset of trying to be long, which eventually I decided was a horrible idea. They say 95% of traders fail, and I think a lot of traders start in small caps because that's where the big moves are. But you've got to think a little bit differently, and I certainly started that way in the beginning, looking at the long side, and that's certainly not the way with those stocks. And eventually, as soon as I moved short, that's when everything came together.
Nice. And were there some trades that you remember that really stand out to you, whether they were like really good trades where something kind of clicked, or maybe they were trades that kind of taught you a lesson? You were going long this stock, and then you got your ass handed to you, and then you decided to go short. Were there some trades that kind of stood out to you and kind of either taught you an important lesson, or like I said, something clicked and you decided, all right, I'm going to lean into that more. That's showing success. I'm going to try to do that more and see how it goes.
Well, truth be told, I was always a little bit of a back tester. I never went really heavy size in any of this stuff. A few small testing trades on the long side. I realized pretty quickly that the long side was not going to work because I was actually back testing before I even began trading. And the long back tests just didn't work. I wanted to be long because that's what I knew, but they just didn't work. So I really didn't have too many experiences where, I made a trade and it blew me out of the water, and then I had to relearn, because from the very beginning, to a large degree, I was always back testing, and so I always had my ideas backed by data. So no large losses, thank goodness, in the beginning, and that's how I got started. Is really with the data.
Do you have a coding background then, or what kind of set you on that approach to start with, I would say?
Yeah, so I don't have a coding background. I'd love to learn, but I do not. But the engineering background, I think, was helpful to me. And I actually dropped out going into my senior year, which is crazy, right? Nobody does that, but that's what I ended up doing. But I got through all the math part. I got through, all the calculus. I didn't get through all the engineering classes, but I got through vector calculus, differential equations, all this stuff. We were using Excel all the time. The fun stuff. Oh yeah, everybody loves a good vector calculus equation. But we were using Excel all the time in labs and whatnot, so I was already very familiar with it. At a certain point, COVID had hit, so we weren't going to classes anymore. But I had all this time, and I was using Excel actively at that time, 10, 12 hours a day to do backtesting. And so really my familiarity with Excel and my familiarity with data collection and data analysis really was good for me in my trading.
And just problem solving, like engineering teaches us how to approach a problem, think it through. What were some of the edges that you started out, testing, some interesting observations you maybe made during your first few years researching? I don't know if you're trained the exact same way you're doing then, but if not, what changed and what edges did maybe you develop later on that you switched to?
Yeah, well, I think I got lucky, first of all, because I found my edge pretty quickly. I actually found an edge within a year of trading the markets, and I've been looking for more edges that are not particularly correlated for the next 5 years, right? Yep. And I found maybe one. So I got lucky in the fact that I found something to trade right off the bat. But I was seeing during COVID, we had the stimulus money coming. Trump was in office. There was a lot of action in the markets. The volume after the pandemic was outrageous. I mean, it was unbelievable. And small caps were blowing up, OTCs were blowing up. But I would see the same thing happen every time, which was they would all come down, right? Just like a ball rolling downhill, they all come back. So I saw sort of that from a macro scale, and I just noticed that everything was going down, and then I picked it apart with backtests to figure out how to actually trade it without getting my butt handed to me like a lot of short sellers end up doing when they have no plan.
Yeah. And when you say that they all came down, was that during the March 2020 correction, or was that, later as kind of the 2020, 2021 fizzled out and we saw some pretty steep, corrections in a lot of those key names? Obviously, I think you might be trading smaller cap names, which are less correlated to the general market. Its moves might be a little bit different, but yeah, what time period are you talking about exactly when you said they're all in downtrends?
That's exactly right. They're largely uncorrelated because they're so small. And the time period, they've acted the same in every period, and I've tested this during the drawdown during COVID, in the bear market of 2022, in the crash of 2024, they act the same no matter what. And actually, if you look at my equity curve during those index drawdowns, you'll see that they hardly affected my equity curve at all, which is fantastic because you have an uncorrelated strategy.
That's what you look for, right? Like, I've talked with a bunch of more systematic guys, like fully systematic, and they're doing a trend following long and then mean reversion short. They combine those because they complement each other, like you're saying. So that's super interesting. Outside of your own research, back testing, looking into the markets that way, were there any books or resources or mentors that you really learned a lot from, or was it more just that personal research where kind of you found the most help, just learning by trading itself?
Exactly. Yeah, I would say that I'm pretty much entirely self-taught. I will say that, as a trader, you sort of are familiar with what other traders are doing. And lo and behold, what I find is that most of the times what people are saying don't actually work. And I think that's true a lot of times for books and online resources and people on the internet, gurus, so on and so forth. A lot of that stuff doesn't work. And I don't have any books that I really dove into because I always suspected that nothing would work unless I looked at it myself and ran the tests and so forth. So, yeah, I would say I just purely observational and self-taught for the most part.
Trial by fire.
Yep.
Nice.
Yep.
And just to kind of maybe give it in one or two sentences, how would you describe your overall style? What's kind of your main objectives and main approach? How do you kind of define yourself as a trader?
Sure. Short only in small caps, specifically nano caps, micro caps, very small companies, and systematic. No discretionary trades. I haven't placed a long trade or a discretionary trade. I mean, 2024, the only discretionary trade I took was on silver, and I've been holding that in 2025. But other than that, it's all on the short side and fully systematic, and day trading in and out within a few hours.
So are all your trades day trades, or will you swing trade a little bit if a trade really falls through and you think there's still more to go, or do you keep it all in one day?
I would love to swing trade because the data is there if you ignore tail risk. Aftermarket, you can get absolutely crushed. So I have to get rid of everything by the end of the day.
Especially in the names that you're trading. I mean, just that's a whole other animal. This is so cool because a lot of the traders who I've had on the podcast so far, they're more swing traders to the long side. So you're like the complement to this. So this will be a lot of fun. Ty, I know you prepped some slides. Do you want to jump into those and kind of dive into your strategy a little bit more and also to your fantastic year in 2025?
Sure. Yeah, we mentioned this a little bit earlier. 28 now, but we kind of went into the engineering background and all that stuff. Live in Carson City now. The account that was in the USIC competition, I consider that my incubator fund account. I started it in 2021, so quite a while ago. And basically its purpose is just to be a track record for potentially in the future a hedge fund. So it's investable now, but it's sort of in the stages of still building a track record.
And your side hustle is pretty interesting. Solar farm vegetation.
So this is the landscape contracting company, which, by the way, day jobs really work well with a fully systematic trading style because it frees up so much of your time. And so I couldn't have started this. I couldn't have done any of this stuff if I was more discretionary, because I'd be watching the ups and downs of these volatile stocks all day long, and I'd never be able to know where to place my stops and my entries and everything like that. So everything is sort of figured out at the beginning of the day, and it helps a lot to free up time. And yeah, so this is basically a combination between environmental engineering and farming, basically. In my teen years, I was a potato and grain farmer, believe it or not. So this is kind of a good mesh. So that's sort of the other hustle. But I made this prediction here back at the beginning of the year, just kind of showing what I expected to make in 2025. And this is just based off of historical returns and based off of the back tests that I have. So I said that I would return between 200 and 400%. And we ended up at 382, I believe. So in the slot.
Yeah, fantastic return.
And then just going back a few years, I'm going to show 3 years of returns, and shockingly, they've been almost identical every year for the last 3 years. This is the same account as the USIC account. I wasn't in the competition in 2023, but this is the returns for that year. I suppose that's about 200%, maybe a little bit more, and minimal drawdown. 2024 is the same thing. pretty minimal drawdown, and about 200% again, a little bit more. And this is 2025. So, going back every year, the charts look just about the same. And these are the results. Started with 80,000 and ended with 386, which is a 382% return. All short trades, 0 losing months. And this is just the breakdown of the month by month.
Oh, nice.
Yep, month by month here on the chart.
So if you overlaid like SPY or the market on all your equity curves, I think it does. Is it correlated at all with the movement of the bigger indexes, or it's really just, or correlate with any other index, or it's pretty much the strategy itself?
It's really completely uncorrelated, Richard. I mean, it's the only note that I would say on that is that it does respond to the volume and liquidity in the market. So let's say we're in a strong bearish market and we saw volume sort of drop down in 2022 during the bear market of 2022. What you'll see happening is you'll see less extreme spikers in the nano caps and the micro caps. And basically what that means is less opportunity to short the big moves. So you'll see a little bit less returns during those years just because volume and liquidity have kind of dried up a little bit. But you don't see any difference in the sense that the win ratio is the same, the win-loss ratio, the profit factor, all that stuff for the majority of the time it stays exactly the same.
Hey everyone, just want to hop in real quick for a word from our sponsor, Public.com. Support for the show comes from Public.com, the investing platform for those who take it seriously. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt, from renewable energy companies with high free cash flow to semiconductor suppliers growing revenue over 20% year over year. You can literally type any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and then lets you backtest it against the S&P 500. Then you can invest in a few clicks. Generated assets are like ETFs with infinite possibilities, completely customizable and based on your thesis, not someone else's. To learn more, go to public.com/TraderLion and earn an uncapped 1% bonus when you transfer over your portfolio. That's public.com/TraderLion. This was paid for by Public Investing. For full disclosure, check out the description below. And we've got a link right down there for you for your convenience if you want to learn more about public.com. Thanks for your support, and we'll be right back. And this strategy that you're working with here, like you said before, is it that core one edge, one setup that you're kind of shooting for, or is it incorporating, a couple other things that you've developed over time?
This is a one-trick pony. Mm-hmm. This is a one-trick pony, but I have sort of separated the one-trick pony into two different areas.
Variations.
One with a high win rate, and one with a slightly lower win rate. I sort of separate them out into two different accounts, but they're still taking advantage of the same moves.
Makes sense. Perfect. Yeah, I'm not sure. Yeah, I don't think I have more questions on that. Perfect.
Let's go to the next slide. Yeah, so the metrics. So in the competition, 238 trades. So not too many. In and out within 4 to 6 hours on all of them. Profit factor, for every dollar I lose, I make $1.54. The biggest winning trade was 29,000. The biggest losing trade was 19,000. And I think I did a pretty good job with that because I was able to sort of size up bigger in the real winning names in 2025 and keep the losers down a little bit, which is good. The largest drawdown was 38,000 or 41%, which unfortunately that happened in January, right at the beginning of the year, so that beat down the account quite a bit. This doesn't affect me so much when it's later in the year, but due to the compounding strategy that I employ, it kind of beats you up a little bit when it happens in the beginning of the year. 41% on that drawdown. And after that, my drawdowns were very, very minimal for the rest of the year. Even during the tariff crash and everything else, everything stayed down to about, I maybe had a few 5 to 10% drawdowns, but nothing bad at all. 157 wins and 81 losses with a 66% win rate, and the average win and the average loss is pretty much similar. It's almost 50-50 on that, with the 66% win rate.
Yeah, what I was going to ask is, outside that 41% drawdown, like you said, is 5 to 15% typical for a drawdown over those past 3 years that you showed? What's kind of the range that you expect for a drawdown, yourself, that you plan for?
Yeah. Well, usually my drawdowns are really not very big, because I size in such a way that I can accommodate a significant drawdown. And I can go into more detail too about how to size in a drawdown. But my drawdowns, I would say, 20, 30%. I usually have one of those every year. In this account, I was sizing a little bit more heavy, especially at the beginning of the year. And that's why we saw a 41% drawdown there. But yeah, I don't usually let my accounts get anywhere near blow up territory, and I always size accordingly so that my account can never get back down close to PDT.
What happened in this case then? What was kind of the factors that impacted this drawdown to make it just a little bit, to make it bigger than normal?
January is a tough month, I'll tell you. I was going back through my back tests, and I didn't think this was true, but so many years in January you see a big drawdown, and I'm almost thinking to myself, I need to change the size a little bit just in January, because it seems like every year there's a big issue there. I'm not sure the exact ticker that this was, but there was a string of 3 or 4 max loss stop outs in a row. And I was sized a little bit larger in the beginning than I would normally be, because this was a competition account. But January just statistically, it tends to be a tough month, and that was true this year as well.
What is that kind of max risk per trade that you like to focus on? And is it based on percentage of your equity? Is it based on an individual position stop loss? How do you kind of think about risk and managing risk?
Yeah, so it's based on the back test. And so let's say I go back 5, 6, 7 years in the back tests, and I see that with this strategy, the largest drawdown for those years was X%. I'm going to keep my size such that if a drawdown of that size happened, a 1 in a 6-year event happened, I would still be okay. And that's how I look at it. So I go back through the back tests, I figure out what the worst string of bad luck was in all that time, and then I'll set that. And even if that happened, I still wouldn't blow up the account. And that's how I look at risk in the account, basically.
And that risk determines your size in that position. You kind of go back from what the risk you're okay to take and whatever your sell rule is intraday, and decide, okay, based on the worst case scenario, I'm not going to be taking more than that acceptable risk for you. Is it fair to say?
Exactly. Yeah. And we can, let me fast forward just for a second here.
Sure.
I'll show you this. So
perfect.
Determining. So I find the sweet spot where the returns are large enough, but the drawdown risk is manageable for the account bankroll. So, let's say this is the back test. Oops. Wonder if I can zoom in. Is there a way to zoom in on that, Richard?
We can zoom in post. So if you just focus on an area, we can zoom in on that for them. Yeah.
So basically, I calculate different stops. So this is each of these rows is a trade, okay? And then I have my risk X% across this whole top row here. And then I calculate that all the way down, and this is basically the whole year's return. Like, okay, right here, this green, this looks like the best. That's 1,800% return off of that position size for the whole year. And then you kind of find the sweet spot where you know what your drawdown is there and you know what your profit is there. The way it kind of works is the more drawdown you have, the more profit you have. So you've got to kind of decide if you're a guns blazing trader and you're okay with taking a huge drawdown in order to accept huge returns. I like somewhere in the middle where you take some drawdown, but you're able to tolerate it, and your profits are decent as well.
Yeah. Some people would say 40. Not everybody can take a 41% drawdown like you did in January. So that's absolutely true. You have to kind of have a strategy that fits your risk tolerance and all that. And is your stop typically based on a technical level? I think we're going to go through some trades as well, and you can show us on the examples. But high level, how do you kind of set your risk? Is it based on a technical level after the open, and then once the trade starts going, that's when you set it? How do you typically set your stop loss?
Yep. So interestingly enough, the stop loss is not based on resistance or anything of that nature. And for a long time, I thought I needed to pay attention to intraday resistance, daily resistance, all of that kind of stuff. But what I found is, to a large degree, that doesn't even matter. And once I started backtesting this just based off of percent loss, as in you're short a stock at $10, it gets to 13 or 14 or whatever it might be, a certain level, a certain percent loss. Setting that as your stop loss across the board for every trade going forward is the best way to go, because these don't really respond super well intraday to support and resistance levels. They're just so volatile. Yeah.
And what are some of the intraday moves? So these stocks that you're trading, what is a typical average daily move for these stocks? Is it 100%? Is it 200%? Or obviously it might depend on the market conditions and the opportunity set. But for the stocks that you trade, what's their typical daily move that you're trying to capture?
Yeah, for sure. It could be anywhere from 100% to 1,000% or more. They move big. I mean, I've traded stuff that's gone from 50 cents to $10. I don't really look at anything unless it probably moves at least 50%. If it goes up 50% in a very short period of time, I'll be interested in looking at it from the short angle.
Right.
Yep, they have to move big.
And you might get into this in another slide as well, but what are some other characteristics that you look for that qualifies a trade? Is it a market cap size? Is it a liquidity thing? Other technical characteristics? What would get you kind of interested in a stock? What are some of the things, if you had a checklist, what are some things that you're looking for to potentially place a trade or place a stock on your watch list to then see if there's the conditions that really meet, your criteria?
Let's go to here. So
sure.
Let me talk a little bit about building a strategy and kind of how I look at this. Is how I looked at it from the very beginning, and all of my strategies sort of started this way. And really, there's only two that I found that really work excellent. But I kind of think of it like there's elements of first principles thinking in building a strategy. And of course, Elon Musk, he talks about it quite a bit. He kind of championed the term first principles thinking, but there's elements of it, because the way I start is I sort of have a broad directional bias. So, for example, everybody knows that the S&P 500 goes up over time. That's sort of a well-known broad directional bias. You're expecting it to go up over time. And likewise with penny stocks, right? Most penny stocks, due to their dilutive nature, they're going to go down over time. So starting with a broad directional bias like that, and then from there breaking it down further to fundamental analysis. Why is it doing this? The dilution, does it have news, things like that. And then the last step of that is the back test. And there might be some technical analysis in there too, like price action, how far did it move, and things like that. So, you know, like I mentioned with penny stocks, there's many reasons for them to go down, and with the S&P, there's many reasons to go up. And breaking the trend down, breaking the macro trend down into a market cap range. So rather than just going with everything, it's better to pick a market cap range instead of trying to trade mid caps with this as well. I only trade the small caps and the micro. And then picking a time frame. I only use the 1 minute time frame, and sometimes the daily just to get an idea of the dilution of the stock. But then I can break it down further into the catalyst, like what type of price action led up to this, and news or whatever it might be after that.
Mm-hmm.
Yeah, that's where backtesting comes into the picture. Once you find the macro trend, then that's where the back tests come in. And back testing is really the core of my strategy, as you know. And there's so many advantages to it. It's unbelievable. I mean, it removes the emotions from trading. It proves the edge, so you have more confidence and conviction in your trades. Increases your confidence. You have less stress throughout the day. You don't have that adrenaline rush or cortisol rush or anything like that that's going to affect the way that you operate throughout the day. And it frees up time, so you can go do your side gig or whatever you're doing outside of trading. It frees up a lot of time, but you still get those returns in. And it improves execution. So with the back testing, you know, I have a graveyard of back tests on my desktop of things that didn't work. I mean, dozens and dozens of Excel sheets that just didn't work. And there have been very few that actually started to work. But I was back testing before I began trading, and very few were tradable. And I've got, 500,000 data points. Most of that was manually collected too, but now we have resources that make it easier to collect data. Even back in 2019, 2020, there were far less resources than there is now. And then this is kind of the difference between the different ways to test things. Like some people, especially discretionary traders, they're more into the forward testing, right? They use real-time data. But I'm kind of more weighted towards the back testing. I use that a lot more. It uses the historical data. It doesn't really factor in the execution issues that you're going to find with actively trading these things. I mean, you might have spreads that come into the picture if a spread is too big, and you have commissions, you have all kinds of things like that. So forward testing is kind of how you deal with that. You should back test and forward test. When you combine them both, then you have a really robust strategy. And then this is the boring stuff, right? The Excel formulas that I use. If
No
then,
differential equations, no vector.
No. Actually, trading was like super easy. When I got into trading, I was like, man, like the amount of mathematics in trading is, it's just percent change and super simple stuff. Really, it's more just persistence of collecting data all the time. But we can go into a back test, Richard, if you want to kind of take a look. And
Let's do it, please. Let's do it.
Yeah. Try to pull this up here.
And where are you usually procuring your data? Is it data providers? Like you said, you manually collected quite a bit of stuff, but and is there kind of a recommended place that people who are interested in this would start, whether that's Yahoo Finance or another place? Where did you kind of get this data over the years?
Okay, so this is one of my older spreadsheets. This is all manually collected, and by that I mean back then I would literally watch a certain number of stocks every day, and at the end of the day I would, from the chart, look at their candles, and I would put in all the open, high, low, close data and all of that kind of stuff like that. But this is just let me show you kind of what you can put into a back test. I mean, this is pre-market information. You can put in, pre-market, open, high, low, close, regular session, open, high, low, close, price throughout the day, price every 5 minutes, price every hour, after hours prices. I mean, you can really go wild with it. And then this is fundamental stuff like percent insiders, percent of institutional ownership, short interest. This is just sort of a discretionary entry, like does it have resistance on the chart? And you can put yes, no here. And all of the cash information, dilution information, stuff like that. Months since overhead resistance. With these stocks that go down every single day, it might be a long time before you go back and see overhead resistance on it. So you can put that
I like
on
the
there.
infinity. I like that. That's
Right?
a good data point there. Yeah.
Yep. And so that's kind of an example of one of my back tests. And it's all through Excel, man. Good old Excel. It costs nothing. Anybody can use it. Anybody can get familiar with it. And then we were kind of talking about stops earlier. And this is how I calculate where my stops should be. I use the if-then function on this and the running total function over there. And basically I'll plug in, okay, if this runs away from me to the upside 100%, or here we have 50%, 40%, whatever it might be, I will stop out. And that's why you see here, this was a stop out. These are all stop outs when they look like this. And then you get all the way down to the bottom. You calculate it at the end. Whatever's the biggest, you look at more seriously. Of course, you got to look at what your drawdown was with that one, but you sort of pick that sweet spot in the middle. And that's how I look at drawdown.
So each of these rows is one stock or one trade in a stock.
Exactly.
How is your system identifying those opportunities? Is that discretionary, or is that a systematic process as well?
Well, I do screen. So, there is a screener that will basically spit out all of the stocks that have big moves to the upside. And those are the ones that I'm watching. So the screener will spit out all of the stocks that made a big move to the upside, and then I'll go through those and find out which ones moved big enough. And this is all at the end of the day. I'll put this stuff in.
Gotcha.
At the end of the day, I'll put in what happened with the stock. And but in the morning, of course, I'm looking at the screener. The screener is going to tell me what I'm going to go with.
And you had some of those fundamental characteristics in there. Of all the factors that you've got, what are some of the most significant that impact your strategy success rate the most? Are there a few data points that kind of stand out to you that prime a stock as one of the best candidates for a short sale if they do get a move higher? Yeah.
Yes. So what I found is, statistically speaking, the number one most important thing is always going to be overextension to the upside. So how much did it move to the upside and how quickly it moved to the upside? And that's the most important one. Of course, you also have dilution. I do look at dilution. I do look at how much cash in reserves the stock has, things like that. And honestly, you can see dilution just from the chart. If you wanted to just cut it short, be super simple with it, forget the filings, you could tell just by looking at the chart which ones are having an offering every couple months and killing their investors with dilution.
So it's just the pop and drops. Does the chart just look pop drops? Yeah,
exactly. And So dilution and how fast and how big it moves to the upside, but especially how overextended it is to the upside. That's key. And in the competition account in 2025, I sort of separated out the ones that were the most overextended, and that's where the 238 trades came from in that account.
And how do you define extended? Is it based on an ATR move to the upside? Is it based on an extension above the moving average? Or is it like a chart eye thing that you've just kind of trained yourself to look for? How do you define extended for potential trade?
So liquidity is a huge thing, right? And we saw just the other day, I think it was PLYX. It moved from like $1 to $60 in 9 seconds in pre-market. And pre-market is the only time a stock can do that because there's no liquidity in pre-market. And so these things can just fly. So that's basically a fake price. So that's what I look for, is how much can this move in the pre-market and after hours in low liquidity. If the day before during regular session it was already overextended, that's even better. But it's best to find something that moved big pre-market or after hours or in some condition of extreme low liquidity, because when the liquidity comes back in, they just die.
And I don't know if I asked this yet. Is there a particular theme or industry that you found makes the best targets for a short sell, like biotechs, or is there a specific industry that that's your bread and butter, you love to trade those because you've had the most success with them in the past?
That's an interesting question. I actually have done a ton of back testing on that, and what I found is it just does not matter at all. What matters is the market cap range, and particularly, most of the time these are going to be less than 50 million market cap. But no, it doesn't matter if it's biotech. I mean, I've shorted things that are in the food and beverage industry, the mining industry, oil and gas, tech, crypto companies. Biotech is a common one that you see, therapeutics, all that kind of stuff. But no, it doesn't matter. Industry doesn't matter at all.
Interesting. And how does liquidity come into play with you establishing your short position? Is it tough to borrow shares sometimes? Do you run into an issue quite a bit where you want to put on a position, but you can't get enough in that you would like to? How do you deal with those kind of execution level issues? The setup might be perfect, your plan entry might be perfect, but you just can't execute the trade or as much as you would like to execute on, for the potential of the setup that you see.
Yeah, well, I'll say locating shares is difficult sometimes, and that's really the key to this business, is finding a broker, first of all, that'll allow you to locate the shares you want to locate at a price that makes sense. And being short is completely different, of course, than being long, because a lot of the things for long traders don't really apply to short because of the fact that you have to locate shares in order to do business. This is why I use wide stops, because, some of these stocks are regulation SHO, which means once you locate, you can only do it once. You make one trade, and then you have to, relocate with every subsequent trade. So you got one bullet, and you better make it work. So you have to have a wide stop. Yeah. So getting up early helps on that, because the earlier you get up, the earlier you can find those shares to locate, because you have to have them before you place the trade.
Do you use multiple brokers for that? What's kind of some processes that you found to make it easier to get the shares that you need?
Mm-hmm. I do. I have 2 or 3 brokers. I use Cobra. I use Centerpoint. I use TradeZero. Used to use TradeZero. But I do use quite a few different brokers because they all have different clearing firms. They all have different pricing for their locates. And so I do pay a lot of attention to that. I found that Cobra is terrific, to be honest, with the locate fees. I like them a lot. But I do have 2 or 3 brokers that I use every single day.
Cool. Getting back to back testing, are there any things that you've changed over the years that mistakes you made early on that now you take into account, and it's improved the efficiency of your back test or improved the effectiveness of the back test, meaning you can trust it a little bit more? Because I think there's a lot of things you have to think about, survivorship bias, all these different things, plus execution stuff. So yeah, are there any kind of lessons you've learned across the way, specifically about back testing, to do it the right way, to approach it the right way, so it's as realistic as it can be?
Yeah. So yeah, survivorship bias. So, well, first of all, overfitting the data can be a problem. And really the best back tests that I've found are the ones that are not too complicated. They're pretty simple. I mean, yes. I have one right here. Yep. So this one is an example of, I use them even this simple, right? You just have open, high, low, close data. And sometimes that's all you need. The one that I just showed had a lot of different information in it, but very few of those columns actually contributed to the end result. So the most simple back tests tend to be the ones that are actually the most valuable. So don't overfit the data. And also, if you're using a service to provide the data, sometimes with these stocks, some will be delisted. And so you have to make sure that those are sort of taken into account or filtered out, or that they're delisted. Or you have reverse splits and things like that can screw up the price, so you have to pay attention to that. I use Spike It. I think they're great. They're a very reliable backtesting software that I use a lot for small caps.
Cool. So this is an option strategy that you were looking at here?
Yeah, this is a zero DTE. I'm about a year ago I got into the zero DTE space, and so far it's been terrific. It's very interesting. It's a lot different than equities, but at the same time, I'm on the short side, so I'm very familiar with all of the risk that needs to be taken into account there, and I'm pretty familiar with that. But zero DTEs is kind of my other strategy that I'm working on, and I kind of combine them both. And to a large degree, this is SPX, so it's the index. And I thought it was great to have something that's involved in the index, because I wanted something that was totally different from the uncorrelated strategy of shorting small caps.
Right. And yep. Are you planning on adding any more strategies, or just kind of sticking with these two? Because like you said, they kind of complement each other. They do. They're hopefully very different. Yeah.
Oh, I'm always looking for more strategies, Richard. I still backtest now, and I'm still looking. I'd like to have 4, 5, 6, bouncing off of each other to sort of complement each other like that. Maybe I could learn a thing or two from you with swing trading and momentum trading and things of that nature, because my long setups are just not there. I'm not familiar with that world.
Yeah. And what was I going to say? What was I going to say? I was going to say it's so interesting. I've talked with quite a bunch of guys that they run maybe 20 strategies on a few different equities too. So, it might be gold that they're trading. It might be, this type of future, that type of future, Bitcoin, and competing strategy within them. And they're always looking for improvements, always looking for tweaks. But like you said, the simplest strategies are often the most robust and work overall. So how do you balance trying to find a new edge versus sticking with what you already have, and just accepting it's never gonna be perfect, but this is good enough, if you know what I'm saying?
Yeah, I think you just get to a point where you've looked at it enough until your eyeballs bleed, and you're like, you know what, this is tweaked as good as it can get. I know what my returns are. I know what my win rate is. As soon as you know exactly what your win rate is and your win-loss ratio and all of your metrics like that, you're golden. at least you know what it is. And then you can make little tweaks here and there to optimize it. But optimizing doesn't take too long. As soon as you know what your metrics are, you can kind of figure out where you stand with the strategy, and then you can look for more strategies.
Yep. And I remember what I was going to ask is, obviously right now you're kind of running those two different strategies. How do you allocate capital between them? Is it based on the opportunity set available to this one, how that strategy has been doing, and if so, do you allocate more to that one, or do you keep it pretty much 50-50 no matter what the conditions, no matter what the trade feedback between the strategies are?
Yeah, I allocate based off of my perceived risk with each strategy. So I would estimate that the short selling of the equities has more sort of tail risk than what I'm doing in the options. There's more of a chance to blow up an account in that space as opposed to the SPX strategy that I run. So there's actually a asymmetric. I mean, I have so much more capital in the options account than I have in the equities, the short equities strategy account, because of that reason. So I pretty much run a number of small accounts in the short equities accounts, and then I run one large account in the
For
SPX. Yep.
And between the two strategies, like you said, you have a bunch of smaller accounts for the short equities. Do you think that is there a point where the edge degrades with too much capital for the short equities, because you have to find shares to borrow, there's some extra stuff going on, there's maybe liquidity stuff? Do you think there is a dollar amount that you wouldn't really be able to get those great returns in?
Yeah.
And if so, how have you kind of thought about adjusting or dealing with that as a kind of take a step back overall trade strategist?
That's a great question, because the whole reason why I was desperately searching for a second strategy was because I knew that the short equity strategy was not an infinitely scalable strategy. You don't see any hedge fund managers with 100 million, 200 million or more that are short a 10 million market cap company. It's not
Right.
common, because it's not an infinitely scalable strategy. The SPX strategy that I run now is pretty much an infinitely scalable strategy. I don't see any time in which I'm going to be more than 1% of the contracts for that strike, right? It's just not likely at all. Yeah, that's what I would say about that.
Yeah, really interesting. Because I have talked with a few other traders who maybe started in the short equities area, and then they moved to other momentum strategies and found a new edge, and just like you're doing, as they grew their account. Yeah, perfect. Take a step back to backtesting. Were there any other key lessons or points you want to make with the backtests that you think might be helpful for folks watching?
Yeah, just kind of continuing what we were where we were going with the backtests. Once you sort of have you can form a theoretical equity curve, right? So you go back a number of years or months or whatever it might be, and you plot this. I plotted this on a graph, and this is actually from 2025, from the USIC account. This was the theoretical return, what should have been made. This is in a different format. This is percent of position size, and this is the dollar amount. But you can see that my performance was pretty similar there. You can kind of notice the different spikes look the same. And the idea is, of course, your forward test, also referred to as your active trading on a day-to-day basis, should match the back test. So at the end of every day, I look back and I look at the dollars that I made that day, and I'll look at what was the theoretical amount of dollars that I should have made that day, and that kind of gives me a sense of how well my execution was. And the idea, of course, is to have your execution be perfect so that your forward test matches the back test. Let's see. Anything else on back test, Richard?
No, I think we covered a lot there. So perfect. Yeah, getting more into your style and what you're looking for. This is good.
Yeah, we touched on dilution a little bit ago, but it's a big part of sort of the fundamental reason for why these things happen. These are the key components of my niche: dilution, parabolic price action when things go straight up in an overextension, changes in volume and liquidity. We kind of talked about that. That can happen in pre-market. That can happen in after hours, at the open, at the close, sometimes even at the 10 to 11 o'clock midday lull. Sometimes that can happen, changes in liquidity. Risk management is huge for short selling. And then borrow rates and locate availability are important as well. And dilution, I always am amazed by these charts because it looks just like some of the things that we saw in physics class. You know, it's like gravitational force. It's like a ball that rolls downhill, and sometimes it bounces a little bit along the way, but it just goes down and down and down. And it's probably a good thing to be familiar with the different types of dilution. We see at the market offerings all the time. That's probably the most sneaky of all, because they can dump those whenever they want, and you don't know how much they dump. Private placement offerings, warrants, these are all things that contribute to the selling pressure. And they file all of these things on Form S3. And you can find these things for stocks if you look up the filings for them. You can see their shelf, which is how many shares that they have that they can dilute with. Sometimes these are fun when you catch the intraday offerings. That's like when you win the lottery. You feel good on those days because they don't happen very often. But when you do catch them, it's like, wow, this is great. So that's a chart of an intraday offering, and they'll crater the price. Yeah, so I thought this was interesting. I used Gemini to help me with this one. I put in an Excel sheet, and it helped me out a little bit. But I did verify that it was correct. So out of 479 microcaps that I traded in 2021, 148 are now delisted. So 31%, 1/3 are now delisted. They don't exist anymore. And only 1% are trading higher today than they did back in January 2021. So, that'll just show you, and these are all just micro caps. So just sort of as a general rule, that's what happens with stocks with market caps that are less than 10 or 20 million. Only 1% are trading higher now than they were back in 2021.
It's the gravitational pull.
That's it. Yeah, and then parabolic price action is really important. This chart kind of shows a halt resume setup, which I don't trade, but this is about the best chart I know of that shows parabolic price action. And risk management is so important with this stuff. It looks just like y equals 1 over x squared or x cubed or something like that. You plot this on a chart, it'll look just like one of these highly dilutive stocks that goes parabolic.
How long of a parabolic period are you looking for? Is it a few days? Is it, a few weeks? Is there a sweet spot there? Or can even just one day, out of nowhere, a pop way overextension, you might look for a short entry the next day or that day?
Yeah, it can be both. So this is an example here of an intraday one, of course, but this is a daily chart of one right here, and you can see. So here's an example. This one went, 4 or 5 times in just a couple of hours, and then dumped right back down. That's fantastic as long as you can get in when you know liquidity will change. But here's basically the same thing. Even though on the trading day, it only went up 50% or so in pre-market, you can see that it had all of this overextension, which equals 600-700%, right? So when things move like that in a 3-4 day period, that's parabolic as well. Straight up and then sort of a ball rolling downhill back the other side. So either way, if it spikes up in 4 minutes pre-market, right before the open or something along those lines, it's very interesting. And also if it runs up slowly over a 3-4 day period, and then you can get in at a peak volume area like this, that can be very interesting as well.
Cool.
It's another example of a parabolic. 2021 was a fun year, man. Yeah, and then this is kind of where volume and liquidity come in. You know, these are naturally very illiquid stocks, but you have those special days when the volume just pours in, and then you can look at it seriously. But the key is to know when volume and liquidity will change. So I would never enter something in a consolidation period in the middle of the day when liquidity is probably not going to change that much. Volume is probably going to remain fairly neutral during that period. I'm looking to get in mainly when the regular session transitions with pre-market. And even here you can see this is, I think this is 4 a.m. here. And a lot of brokers will not allow you to trade until 4 a.m. So you often have a huge liquidity change at 4 a.m. Pacific. And then, of course, you have the regular session open, which is 6:30 Pacific. And you can see the volume just pours in. It pours in here. It pours in here. Back here, you can see it poured in right as the after hours came in. So that's really important because you don't really know which way this is going to go when that liquidity changes. It could go straight up or it could go straight down. But at least you know when to enter the trade. And at that point, you immediately set a stop loss just in case, right? It's interesting because just sort of across the board, both in small caps and in large caps and in the S&P, big moves tend to happen in low liquidity. If you actually backtest the S&P 500, you'll see that the S&P 500 is actually flat. If you just look at intraday returns, the SPY intraday return is 0. So if you bought SPY at the open and sold at the close, and you did that every day for 20 years, you would make 0 money. But if you did a purchase at the close and a sell at the open, it would be a lot different. So just generally speaking, the big moves occur during periods of low liquidity. And I know that the NASDAQ and the New York Exchange are about to change their rules and make trading 24 hours a day or 23 hours a day, which is going to be interesting because that's going to make the markets a lot more efficient, but it's also going to even out liquidity throughout the day. And that's going to change a lot for my strategy, I think. And I think for a lot of people as well, because big changes in liquidity and being able to know when those big changes are going to happen are very, very important. And I know a lot of traders, I see a lot of people trading 20 minutes a day, but they only trade from the market open for the next 20 minutes and then they stop. So, volume and liquidity are very important.
And I want to emphasize what you said just a few moments ago about, you're entering at a point where you're expecting a big move to happen. Mm-hmm. You're not quite sure which way it's going to go, but you're going to cap your loss on one side, and if it goes the right way, you're on for the ride. So that's like every trading strategy can be summarized down into that kind of core concept of a big volatile move is going to happen. If it happens, great. If it goes the other way, we protect ourselves somehow, whether it's position size, stop loss, sell rule, whatever it is. But if it goes the way we're expecting, we're trying to ride that trend, ride that move. So
Right.
I just want to say that.
Yeah, and it also kind of boils down to, during those periods of changes in liquidity, can you find a time when the stock is more likely to pick a direction? So if you look at sort of times throughout the, times throughout the day where the stock is static, there's no real change. Like this is pre-market, right? Nothing really changes there. It might spike up big or it might go down big. It could go either way, but it's more likely to pick a direction at the open, and it's more likely to pick a direction at the close. You can see right here, I used to experiment a little bit with going long on squeezers at the close. Couldn't quite figure out the metrics on that, but that's something that can happen as well. So I would never, like I said, I would never get in at a place where there's consolidation, because shoot, you might have 2-3 hours of consolidation where you don't know where the stock is going. It might just creep up slowly or creep down slowly. So you should pick a time where you know liquidity is going to change big and it's more likely to pick a direction.
I love that. Well said.
And then the next thing is risk management, right? I mean, short selling is one of those types of trades where risk management is extremely important, because you have infinite loss capability and you have finite gain capability, which is the opposite. Sometimes I envy long traders because they don't have to worry about that. They can potentially enjoy 1,000% gainer and only worry about a few percent to the downside. So it's a different animal when you have to be wary of large upside moves that can blow you out 100% or 200% or more in a very short period of time. So stops are very important. And we kind of touched on this, but wide stops are needed when you're trading stuff that's extremely volatile. Manipulators are going to know where to squeeze these things. And I've seen it happen over again where they will pick locations on the chart where they know that shorts are in trouble, and then they'll squeeze you out. So it's actually fascinating to watch. Just as another anecdote, I know that a lot of people push breakouts, and people push trading breakouts even in small caps and micro caps. And going back to the data, what I found out is that, believe it or not, that's a potentially optimal time to go short, because manipulators or insiders or whoever it might be tend to wait for the breakout, because that's when liquidity pours in from people who are trying to catch the breakout on the long side.
Right.
And they dump it on the very next candle and you get crushed. So breakouts, or you can call them fake outs, they can be an excellent time to actually go short in some of these. And manipulators know when to get in there and squeeze the shorts out. They can make a lot of money doing that.
I've talked to some.
Yeah.
Oh, sorry. Just to jump in, I've talked to some traders who have been trading for a couple decades, and they say more and more, breakouts used to work great in the 90s, but more and more they wait for the breakout that fails, the reset, and then, the fresh breakout from that, where a lot of people have already gotten pushed out, or maybe the people who are looking to sell, get short, have already, sold short. So they're waiting for that second reset setup versus, looking to go long right at the area on the market that everybody knows something's going to happen, right? So I think that echoes exactly what you were saying. Yeah.
Exactly. And patience seems to be key. I've seen this even looking for bounces. I don't trade bounces, but I've seen it with that too. A stock will break down, it'll dip huge, and then you think that that's the place to get in, and then set your stop for just slightly lower, at the bottom of the dip, but then it dips one more time. So it seems like the double dip, so to speak, is super common on the long side if you're looking at that trade, and then on the short side as well. If you're patient enough to just wait for your opposition to get blown out, in other words, other short sellers to get squeezed, wait until they get squeezed real bad, and then you have a real opportunity. And probably is the same for dip buying. Wait until longs get really beat up multiple times, and then get in on the second dip. So you're absolutely right about that. And then short locate fees, I try to keep these to below 2 to 3% of position value. I'm probably trying to make 10%, 15%. I think my average gain per trade is across all of my short accounts, they tend to be about 8, 9, 10% per trade. That's kind of what I'm looking at. So of course, if you're locating shares and that locate fee amounts to 8% of the position size, that's crazy. You don't want to do that. You're just working to break even, basically.
Right.
Not to get paid. So on average, I went through my stats the other day. On average, my fees paid tend to be about 1% of the position value, because these are hard to borrow stocks. And I touched on this earlier, regulation, SHO. Basically, stocks that are in that category, you can only locate once and trade them once. As soon as you close out the position, you have to relocate if you want to go for a second try. So that's why wide stops are important, especially on stocks like that, because you might only have one bullet to trade that.
And Ty, do you have a story or maybe a ticker that comes to mind where it was the perfect setup, it was going to be an A+ trade, but you just couldn't find shares and you missed it? It worked out just exactly like you wanted it to. But yeah, you either missed the trades or didn't get nearly enough size that you wanted, simply because you weren't able to locate the shares needed to execute properly.
Yeah, I have an interesting anecdote on that, actually. Yes, that happens all the time. It happens all the time. It's very frustrating. But sometimes what I notice, and I have this in the database as well, what I find is the stocks that have extremely high locate fees, I mean, we're talking 5, 10, 15, sometimes 20% of position size you would have to pay to locate these things. I find that those are actually more likely to squeeze. And fundamentally, conceptually, it makes sense, because if you have that much demand from the short side to locate shares, that the clearing firm runs out of shares to give out, that means that a lot of short sellers are sitting there waiting to be short, and there's more potential to be squeezed. So sometimes I'm saved by it, because I'll be looking at a setup that's a really nice setup, and I'll be trying to locate shares. I'll be up early in the morning, and I'll try for hours to locate shares at a reasonable price, and I just can't find them. And then an hour later, I see that the stock is squeezed up 200%, and I'm like, thank God. I'm so glad that I wasn't able to find anything to locate there. So, yeah, I think that's kind of interesting. Also, what I find too is that sometimes my broker will actually restrict trading. And this is very, very uncommon. It only happens a couple times a year. But the extreme overextended stocks that just run wild, that I'm really excited about shorting, sometimes the broker will restrict completely, and you can't locate shares, you can't trade it at all. And I don't know exactly what their metrics are for figuring out when to restrict trading. But what I find is a lot of the time that's when to be long on that stock, because they know something that I don't. And I would love to be a fly on the wall of however that restricted trading protocol works at the broker level, because they know something that I don't, and a lot of times it seems like those are the stocks that run wild. So I have noticed that as well.
Yeah, nice.
So sometimes
And
it
you
saves your butt.
oh, that is a good thing.
Mm-hmm.
And you touched on this already, the sweet spot. Yeah. So yeah, halts. I wanted to ask you about this. So yeah, how do you deal with halts while you're trading? Both
Yeah.
well, I guess the emotional side and execution side as well.
Well, the best way to deal with them is to stay away from them.
Yep.
If possible, you should probably try and stay away from them. You can't always, because these are very volatile and you just have to deal with it sometimes. But for one, try and stay away from stocks that are just halt, resume, halt, resume, halt, resume, like that first chart I showed of Duo. This is not something that you should be trading because of this reason. Where's the top? You're never going to know where it is, and you can get blown out so quickly on those. This is a stock, this picture here, this is a stock that I got beat up on really bad in 2025 because every once in a while, this is not common. By the way, let me just detail what this is. LUDP, limit up, limit down protocol. These are the most common halts, and they have these stocks have halt bands, and when it goes up 5% in, I believe it's 5 minutes, something like that, when it goes up a certain percentage in a certain period of time, they'll halt it for a certain amount of minutes. I've seen 5-minute, 10-minute, 15-minute, 30-minute halts. And every once in a while, usually it'll reopen about where it was trading before, but every once in a while it'll gap. And this is the biggest gap that I think I've seen in my trading career from a LUDP halt. We were at, looks like 65 all the way up to over 100. So it almost doubled in one gap from one limit up, limit down halt. And if you're already close to your stop loss here, you can get blown out really, really, really bad. So I actually have adjusted my trading a little bit. And when I see a stock that has potential to halt a lot or has been halting a lot throughout the day, what I'll do is I'll actually scale out of the position. So I'll be out 20% here. I'll be out 20% more here. If it does do something extreme like this, I can sort of limit my losses because at this point I'll only be holding quarter size, half size, something like that. I'm still using my back-tested statistical stop loss. Let's say it's 50%, but I'm scaling out at 30%, 40%, 50%, 60%, 70%, 5 different orders, and they scale out that way. That way you can sort of mitigate these gaps. But that's definitely something to look out for is the LUDP halts.
Can you feel in the tape at all, when a halt might be coming? Is there anything you've noticed there, or it just might come out of nowhere?
Yeah, I mean sometimes you can weasel your way out of a position if you really want to get out. Sometimes you can see it stack up on the tape, and essentially they've already halted the stock, but you'll see that the ask and the bid, it'll stack up on the bid, but the ask isn't moving, and sometimes you can sort of get out your position just right at the last minute, but it's tough. I'm not a tape reader, and a lot of the time I'm just too slow for it. But before they halt the stock, there's really not too much that you can do. You might know some tape readers that are better at me at that part, but I haven't been able to figure out a way to predict when a stock is going to stack up on the bid and fly up 5% in 30 seconds.
Yep.
Lots of different kinds of halts. The scariest thing I've ever experienced was the T12 halt. And this means information is requested by the exchange. T1 is very bad as well if you're stuck short in a news pending halt. these are really, really dangerous because you can be stuck in these for days, weeks, months. And this is one, I think this one, TCGL, is still halted. And I saw some short sellers on Twitter complaining about this one, and I was thinking, I'm sure glad I'm not in that one right now. And I think this has been halted for several weeks now. And the scary thing about that is that the clearing firm is still charging you overnight short fees every single day. Yep, and it can be really extreme. I have protocol in place to avoid this scenario to the best of my ability now, but I did get caught in one of these several years ago, a ticker called TNON. I believe it's still trading. And in that situation, I might actually, do I have a chart here? No, I don't. That's a different scenario. But I was stuck in a stock and it halted T12. I was stuck in this one for 2 weeks. The interest rate was over 1,000%. So I think I had a relatively small position size at that time, but I was paying like $500 a day just to be stuck in this thing. And, you know, if you're stuck, I've seen some of these be stuck for months, 6 months. So if you're stuck for 6 months in something that you're paying 500%, you know, over that period of time, my goodness, you can rack up some insane losses. So this is a very, very stressful thing. I don't wish this upon any person. It's awful. You don't want to be stuck in these. Very depressing. There's nothing you can do. When I was stuck, what I did is I called the broker. They got me all the way up to the top. I believe this was TradeZero at the time. They got me all the way up to the top, and I talked with somebody who was talking with the SEC, and eventually what ended up happening is I was able to negotiate, after the stock resumed, I was able to negotiate the fees down to the point where the broker was making zero money. Usually there's sort of a amount of profit that the broker makes on top of what the clearing firm makes. The broker agreed to pay zero, to receive zero compensation for that. And so I only had to pay the clearing firm. So that part was good. Thank you, TradeZero. But these are no fun. These are no fun at all.
What's part of your protocol to try to avoid these, if at all?
Yeah. So what I notice is a lot of these T12s happen in extremely low volume stocks. So basically what I look for is volume now. I trade things with a lot more volume. For me, what I look for is in the millions in the pre-market. If it's moving in the pre-market and I'm watching that price action, it has to be in the millions for volume. Every one of these that I've seen has been just a few 100,000 shares or less trading. So that's what seems to happen. And I'm not sure, you know, my suspicion with this is that the SEC is more likely to speed up their investigation when more people are stuck, because you've got more complainers, you've got more big players, more hedge funds, more people who are big names that are stuck in this thing that want out. So if you've got $300 million that's stuck in a trade as opposed to 500,000, which one do you think is going to complain more to the SEC to get it resolved quickly? So that's my suspicion on how that works. But I have noticed that the lower volume stocks tend to T12 and T1 more than the high volume.
Do you care about stock price at all? Like, will you favor a stock that's in the single digits or teens versus stock that's legit a penny stock? Does that impact it at all? Because that's, you know, volume plus liquidity kind of, you know, plus the price creates the liquidity. So yeah, I was wondering if that's part of your process.
Yeah, I prefer anything over $1. Mainly the reason why is because locates start to get really expensive when you get below $1, because each share is each share is 40 cents or 30 cents or whatever it is, it might go down, but locates tend to be proportionally a lot higher for those ones. So I don't like spending 5, 6, 7% on locate fees. So usually what I end up doing, because you have to locate tens of thousands of shares, as opposed to a stock that's at $10, you only have to locate a few. So that's kind of my thinking on why I restrict it to $1 or more. And that's kind of my threshold there. It's better when it's higher. I love a stock that started out at 50 cents but went to $20, double digits. That's the best. That's the best situation.
Cool.
Overnight holding. This is another risk management thing that you should really look at. For the same reason that these become good shorts, they can also blow you out if you overstay your welcome. So tightened liquidity can cause the order books to thin out, the spreads get ridiculously wide, volatility goes up and you get blown out. This is another scary moment for me. This was a real learning lesson that I had a while back. I was, for a time, holding shorts overnight up to 5 days at a time. And the returns were fantastic because after that initial spike, they just keep going like the ball rolling downhill, right? Every day it'll go down 5% more, 5% more. And you can really lengthen out your winners that way. But there's some huge risk in that because I didn't really pick up on this until I was stuck bad in this one here. What ended up happening is it was a good trade. This was my entry here. It's funny because you can barely even see what happened here because of this ridiculous spike the next day. But I entered here. I held it. I was going to close out late day, my normal 4 to 6 hour trade. But this stock had no news. And I had only made 3 or 4%. And I was thinking, well, when liquidity dries up, it's gonna drop. And I think these guys had a huge shelf that they could dump at any moment. And by the way, shelf is basically their pot of gold, their dilutive shares that they can dump whenever they want. And I think they were primed and ready to do that. So I thought, I'll wait, I'll hold it, and I'll cover in the morning. And at 1 o'clock in the morning, this thing spiked from about $5 to $125. And thank goodness it came back down by the time I woke up. I lost, some money, but it was manageable. But I looked back at my unrealized loss at 1 o'clock in the morning, and it was over $250,000. And I thought, I will never, ever do that again. So that was a learning lesson there.
Wow.
Yep. We kind of went over drawdown risk a little bit earlier, but this is kind of how I go through and I find the worst drawdown that's ever occurred going back a number of years. So here I went and looked at 2014 and I saw that for each of these setups, you find the max drawdown. And so this is the max drawdown row, right? And this is the sum of the percent gains for that strategy throughout the year. And you kind of pick one that looks best, one that has the relatively high gains, but the drawdown is manageable. So I guess in this case, I would pick this one here.
Yeah.
Mm-hmm. Yeah. Just some more thoughts on locate fees. Go shopping before peak demand, because if you're gonna watch a stock and be excited about it and you're ready to short it when that thing is primed and ready to go, but then you go and do so and the locate fees are out of hand and you're paying 5-10%, then you can't even short it. So this is kind of where predicting what's going to happen in the future is important, because you want to sort of go shopping for those locates before peak demand happens. So you're almost, in a way, you're kind of trading the locates as well, on top of trading the stock. We already went over the locate fees and high locate fees being more likely to squeeze. We can talk a little bit about the compounding strategy. So this is kind of the equation that I use, and I didn't always do this. I had static position size for a long time. In other words, I would just trade, let's say 10,000 per position size per trade, and I would keep it there for months and months and months, maybe for the whole year. But I much prefer now growing small accounts by dynamically changing position size. And the way I do that is I figure out what the max drawdown is likely to be through the back test, and then I never decrease size throughout the year. I just trade in such a manner that if that 400% drawdown were to come, I would still be okay. And I increase size like that. So this is my equity curve. And I increase size throughout.
And I actually wanted to ask this, Ty, are you putting all of your account into a ticker at a point, or are you trading multiple tickers at a time? How you kind of split up your account? Basically, do you trade all of your account, or do you split it up between different trades?
Yeah, so I trade a very small portion of the account. So I trade multiple tickers per day. And on an average day, I would say that I trade 3 or 4, depending on how hot the market is. But I'm in several on most days. Today I was in 1, but yesterday I was in 2 or 3.
Mm-hmm.
And I size those such that they're just a portion of the account.
Right. Cool.
Yep. Yeah, best trade of 2025. This one was fun. So we can kind of go into the best and worst trades.
Let's do it.
Yeah, so CWD. So this was awesome because we had this big crypto run after the election. And for the next number of months, crypto was a big deal, and it seemed like every small cap company that wasn't worth a darn was releasing press releases saying that they're going to create a crypto treasury, which basically all that means is they're trying to become mini MicroStrategies, right? Mini Michael Saylors. And that was a big theme there for a while. All of these tiny little companies were releasing this news. And this was great because this stock here just blew up on that news. But it was kind of to the tail end of the news cycle. You could see that this had been happening for a long time, a couple of weeks anyway. And this is the best time. I love watching these news cycles unfold, and you can kind of tell that these are kind of a bunch of baloney. The news just isn't really that bullish for the stock, but for whatever reason, it's been overhyped for several weeks, and you can just sort of see the percent spikes start to go down in the last few days that this happens. And this was one of those, and it just spiked up huge in the pre-market from $6 or so, $5 all the way up to 56. This is a true parabolic here. True parabolic. And then it kind of consolidated right here with some wick downs. And they also had just under 1 million shares held in their shelf that they could dump. These were ATM shares, so that's an at the market offering. They can dump all 1 million shares whenever they want at any price without any warning. And when this happens, you can expect they're probably going to try and do it on that spike, and they're probably going to try and do it right at the market open when the liquidity is the highest. So this was a fantastic trade. This was actually the largest trade. I think this was that 29,000 trade in the USIC account. Perfect setup.
So for this, yeah, great setup. For this one, Ty, are you entering right off the open and setting your stop at whatever it's at? Are you waiting for any technical pattern? How are you actually kind of executing the short sale?
This was an open short at the open trade. Yep, that's right. And I shorted this right at the open, just before the open, I should say, about 2 minutes before. And I set my stop at my my stop loss that I put for almost all of these trades. They're the same for almost all of them because they're optimized for this setup. So, yep, shorted it just right before the open pre-market and set the stop and rode it all the way home.
Did you close it out right at the close, or is there a process by which you decide, okay, it's extended to the downside a little bit, the snapback, there's a high likelihood of that. I'm going to close out at least some. How do you typically cover your position?
Well, you want to hold these for as long as possible. And I mentioned earlier, I was trying to hold a lot of these overnight for 5 days, and I couldn't do that because of the tail risk in that. But you want to try and hold these for as long as possible. So I used to also hold in the aftermarket and just watch it and be super careful that it doesn't spike up crazy. Nowadays, I pretty much get close to the close and I close everything out. I don't mess with it anymore. I've tested taking profits at different levels throughout the day, an hour before the close, 2 hours before the close, and so forth. And optimizing that, it's best to close out pretty close to the close. That's kind of what the data is showing me. Now, what you can do also, some people are really good at recycling shares, and let's say we cover right here at a certain, if it dips 20% in 5 minutes or something ridiculous like that, sometimes it's good to close that out and then try and scale back into the position on a bounce. I will do that on a discretionary basis from time to time, but most of the time, this is going to be short it sometime close to the beginning of the day and then hold it for the majority of the day.
I love the ingredients that came into this trade. Your awareness of that news cycle, that pop on everybody becoming a Treasury, and then that kind of opportunity weakening, and then the at the money shares having that awareness as well. Is that something? How do you find out about the shelf offering that's available at the money? Is that something that there's a press release from the company that you're aware at, or how do you kind of find that info?
Sure. My favorite thing to do is look at Dilution Tracker. It's fantastic. And we haven't always had these resources, but to some degree I feel like we're living in the golden age of trading where we're like before AI comes and kills us all in our sleep, but we're after the point where we have to work super hard to find information. We're kind of right in that zone. And it's like really awesome the amount of resources that we have right now. And trading's never been easier for me. But Dilution Tracker is what I use a lot of the time to find the filings. You can just put in the ticker symbol and it'll spit out cash left in cash reserves, how many shares are in the shelf, what type of offering is in the shelf, whether it's an at the market or whatever it may be, warrants, convertible notes, all that kind of stuff you can find there. And that's how I do that.
Yeah, and then did you find this one with a pre-market screen, just looking for a percent change pre-market, and then you looked into Dilution Tracker, saw what other ingredients were kind of coming into place for this trade? Is that your typical process?
Yes, that's correct. So it'll pop up on the scanner. Things pop up on the scanner on DAS. I use DAS for everything, and I put in big movers, things that move a lot very quickly. And as soon as I know that information, I'll take those, plug them in, and figure out which ones have dilution. It's not sort of it's not a limiter on whether or not I trade it. the dilution, but it is going to sort of be an indication to me about what price action is going to look like throughout the day. For example, what I find is stocks that don't have dilution and they spike up huge, they're still good shorts and you should still take the trade. But what I find happening is a lot of times they'll dump right at the open and then they'll just grind back for the rest of the day. So in that case, you would cover pretty early in the day. You might not hold it until the end of the day. It would appear that shorts are excited to get into those, so they short it heavy at the open, and then they grind back because there's no dilution. So that's what I find there.
And then for this trade, and maybe thinking of more typical trades, are they all as clean as this one? Just, your best trades that you find make the big difference, that they just drop right away as soon as the regular market opens? Or are there some that kind of have this false move higher and then they go, have you noticed that amongst your best trades, the ones just drop right away versus, it just depends on the situation where there might be a little bit of consolidation off the open? Yeah.
Oh, sometimes you just go for a ride and you just have to deal with it. Yeah, absolutely. I mean, this is a trade that is perfect. It's set up perfect. I knew it was going to be perfect, but this happens about once a quarter, 4 times a year. And most of the time...
If only it was always easy.
Right, exactly. Well, that's why I sized up almost double on this one. Most of the time they end up being a little bit closer to this, where you have a little spike at the open, and then you might have what you want, or maybe they might blow up here and then come back down. I mean, it just... You kind of know the overall trend, but you can't predict the volatility.
Nice.
Yep, that was the best one. And then, nothing was too major on the worst trades for that account, but this was from the options account. This is zero DTE land, and so for those that aren't familiar with zero DTEs, that's a different topic. But the worst time of 2025 was right during the peak of the tariffs, and I was short calls and puts. But what ended up happening is I was short calls, so out of the money on this big green day here, and then I went and stepped outside for about 20 minutes. And in that 20 minutes, I came back and I was blown out 50 grand. And that was no fun. And I was already down quite a bit from some other things that happened during the tariffs. Luckily, everything straightened out and the rest of the year was fine. But I looked it up later and I thought this was interesting. The number 8 biggest one-day % change to the upside in the S&P occurred on that day. And it just happened to be that day that I stepped away for 20 minutes. But that's how it goes, isn't it?
It was a crazy move. Absolutely crazy move. And 2 days earlier was also a crazy move, but it doesn't even look that crazy because of the one that moved higher and then faded right off the lows. But yeah, that was what a crazy day.
Yep. I'm very interested in volatility arbitrage and things of that nature. In hindsight, what I should have done is been short volatility on April 7th or April 6th and just forgot everything else. That probably would have been the move. Maybe I should have bought puts in VIX or something like that. But that was a crazy time. Yeah, and then I suppose, wrapping up what I have in these slides, I would say mindset-wise, it's really helpful to sort of expect to not make any money, because as soon as you have expectations, it seems like emotions kind of come into the picture, and that's never a good thing for any trader, whether you're discretionary or systematic. It's not a good thing when emotions get involved there. And that's kind of also why I think it's good to have a side hustle, because even if you're just making 30 grand a year, put a roof over your head, a little bit of food on the table. It takes the pressure off of you, so that if you're in a drawdown, if you're in a tough patch, it's not going to be super, super stressful and make you make emotional trades. So focusing on execution over income has been really important for me. Back when I was broke, during my college days, I was living in a camp trailer in my best friend's backyard. It was a nice trailer, it didn't leak or anything. But this was my first year going full time. I had above my trading desk a printed out 8x11 piece of paper with bright red capital letters that said execute, execute, execute. And I kept that there all year because I knew how important that was. I knew that even back then that was going to be the foundation, because as a systematic trader, all you have to really do is do exactly what your system tells you to do, and you're going to be okay. So that's really important. And then, this is something that I think there's some confusion over, which is sometimes I'll have a day where I make some money. Let's say I make $5,000, and somebody asks me how the day went, the trading day, and I'll say, "Oh, it was awful. It was a terrible day." And then they'll ask, "How much money did you make?" I'll say, "I made $5,000," and they'll laugh, they'll scoff at it, be like, "What do you mean?" But I'll say that my back test indicated that I should have made $15,000 today. And they'll say, "Well, at least you made 5. That's a good thing. Just take the green and be happy." Well, unfortunately, that's not really how trading works, right? Because you have a certain number of winners throughout the year and a certain amount of losers. And if you're taking profits early on all of your winners, but you're max lossing all of your losers, then that equation does not work out. So I look at it as greed. I mean, really, that's what it is. You see green on the screen. Oh, I better take it. But that's the definition of greed, right? Is wanting to take the money. So that's something that I've had to fight quite a bit, is taking profits early and focusing on riding those winners out to their full potential is really important. And I'm sure I've seen you interview quite a few long traders that feel the same way about that. For short selling, a contrarian mindset is really important, because you are trying to catch the window of time when sentiment shifts very rapidly. So you have to be looking at it from the other angle as everybody else in the lead up to that change. I mentioned earlier, I don't really read trading books. I don't really have too many mentors, but I suppose that's because I think that everybody's wrong, and bears are perma pessimists. But yeah, I mean, look at reverse Jim Cramer, right? Jim Cramer, the analyst, he's always wrong. It seems to me too, like what you see on news, the news channels, when they're really pushing something on the news, it seems like the next day everything dumps. And I'm not sure if that's because liquidity is highest and everybody dumps into liquidity, or how that works, but there's something going on there for sure. Seems like experts are wrong a lot. It seems like the friend that you have who talks about trading all the time but is not a professional. With this silver run up that we had, when people start coming up to you and asking you, getting excited about trading, "Oh, how do I buy more silver?" and this and that, and it's the big talk of the town, that's when you know that the bubble's about to burst. Same thing with GameStop back in 2020, 2021. It seemed like everybody was talking about GameStop and started getting super excited about trading. That's when to really be looking at it from a contrarian view, that the bubble is about to burst.
On GameStop, I think the top day I had about 3 or maybe even 5 friends, family members text me about what's going on with GameStop. The exact top day, nothing before,
Yes.
nothing really after the top day. It's amazing how that works. And I think it's like the news cycle thing that you notice with the the Bitcoin Treasury thing. It's like later in the cycle, that's when everybody's going to be picking up on the opportunity or what was an opportunity at one point. So it makes perfect sense.
100%,
You have
100%.
yeah.
And I watch my phone, and you're right. It seems like when I get those text messages, that's the within 24 hours of receiving a text message from a friend about trading, that's when the bubble in question is about to burst. And I've seen it a couple of times now. It's super funny. Yeah. Yeah, we talked a little bit about the 24-hour trading and how I think that's going to affect the operations of day traders. I really like, what I'm doing in options now as a complement to the short selling. It's still shorting options. You can call it option selling. You can call it options writing, whatever you want to say. But they can sort of be synthetic. They can be synthetic long or synthetic short. If you sell a call, you're basically short, and if you sell a put, you're basically long. But I think it's a really great complement to be involved more in the indexes and the overall movements of the market, and then have one strategy that's opposite to that and completely uncorrelated to what's happening in the indexes. So I think that's really important. I'm always looking for different strategies. I'm still back testing even today, even though my desktop is a graveyard of failed back tests. I have 2 that work, and I'm always looking for more. And I really have this utopian vision of what a fund would look like. And I often notice Jim Simons and the way that he ran his fund before he died. Medallion fund was one of the best funds in the world, and he did it in somewhat a similar fashion to me, very strictly focused on the data. He was a mathematician, and rather than hiring traders like a proprietary trading firm would do, he decided to hire the best graduates, the smartest scientists, the smartest physicists, the smartest mathematicians, put them all in a room together and say, let's look at the data and let's develop a strategy. And I think that's great. So I kind of, look at all the traders that you've interviewed. They all have their different unique strategies. They all work. They all have different metrics, different win rates and so forth, but they all work. And many of them are very much uncorrelated. So think of the power of 5 of the people you interviewed, 5 traders with uncorrelated strategies, each making 100% per year, and what kind of a fund you could create with that. It could be incredible. But with that, I mean, that's all I have. I mean, do you have any questions? Other questions for me?
I've got just a few more, Ty. First of all, this has been great. Like I said at the very, very beginning, it's so different from the folks I usually have on. So it's so cool to hear your perspective. And going back to Jim Simons, I highly recommend reading I think the book was called, I forget what the book was called, but it was quite good. Demystifying, I'll find it in just a second, but there's a really good book on that. And then also he did a interview with Numberphile on their YouTube channel where he talks about finding those physicists, looking for anomalies in the data. That I don't know if you've seen, but I think that was a really interesting watch as well. Really interesting guy. Ty, I think mainly I'd love to hear a little bit more about day-to-day process, if you wouldn't mind. So, if you could take us, starting from when you wake up, what are you kind of doing step by step to prepare for your executions during the day? You've talked about, looking for shares to borrow in pre-market based on the opportunities. But yeah, if you wouldn't mind taking us through your day from when you wake up, so how you're prepared both mentally and just execution wise to trade that particular day.
Yeah, I would say getting up early is important, especially on the West Coast. So do that and get up. If you're watching things pre-market, get up in pre-market so that you can pay attention. And I always have my spreadsheets, or at least I try to if I remember, but I always have my spreadsheets open so that I can sort of just have fresh in my mind my back test. and I'm
Your
sort
goal,
of,
your backtest, your system.
yeah, it's my goal. It's my system. It's my goal. I like to have it in front of me so that I don't forget. You know, sometimes I do slip into some bad execution, and what I find is the reason why I slip into bad execution is because I don't have those things in front of me while I'm trading, and maybe it's been a few days or a few weeks since I've input data into the sort of ongoing back test that I do, filling it in with the forward test data. So I like to have that in front of me. I like to have that in front of me so that I can execute on that. And locating shares. So I'll get up early, look at the screener, which is essentially all of the top gainers, what's moving big, what has high volume, what's overextended. There might be something that moved aftermarket the previous day, which actually, that's my favorite setup, is something that's moved big aftermarket the previous day and has blown up, and then it's sort of consolidating in the pre-market. And
Gone quiet.
Mhm.
Okay, interesting.
Yeah. Yep. And so I'll have those in my mind, and those will show up on a screener, usually as a gapper. Usually that's what it'll show up as. So I'll look at the screener, and then once I see what's moving, right about, let's say we're market opens at 6:30, right? Let's say we're at 5:30. I'm going to look at all of those movers, and then I'm going to check for dilution first. Then I'm going to go straight to locating shares. And I might spend, 10, 15 minutes going through my brokers, figuring out which one has the cheapest locate. I don't know if you're familiar with DAS, but they have their locate feature has 10, 15, 20 locates, depending on your broker. And you just got to kind of scroll through them and go shopping, basically. So I'll do that in pre-market. I'll trade the locates, so to speak, and I'll do that in pre-market. And then when the market opens, it's go time.
Awesome. Well, Ty, thanks again so much for your time. I love my favorite interviews are the ones that make me think, and this one definitely made me think. So thank you for that. Do you have any kind of general advice for traders out there as they're finding their edge, as they're developing their system, or trying to achieve those bigger returns? Anything you would say, kind of an encouragement, or just as general advice to those folks?
Yeah. Just to wrap up, I would probably say that data collection, and we've gone over this for a while, but data collection and backtesting are so important, and they're so underrated too. I mean, I don't even know very many traders that take it that seriously. I'm sort of in that middle ground where you have algo traders that are good at coding, right? And then you have discretionary traders that don't really pay that much attention to backtests and data. I'm somewhere in the middle where I do everything sort of manual executions, no coding, but strictly systematic. And I feel like it's so underrated. I feel like to really bring your trading game to the next level, I think it's just crucial. That's my opinion, and that's my conviction on that. So be a contrarian. We were talking earlier about when your friend texts you that they're excited about the markets, that's when you should be looking the opposite direction. So kind of try and look at things a little bit differently than the general consensus. I think that's really important. I was going to mention too, real quick, drawdowns are something that everybody struggles with at some point. You've got to decide what you're going to do when you're deep in the hole. And for me, I've actually found statistically, because of the fact that shorts get blown out the worst in a drawdown, because that I'm in a sort of a niche channel of stocks and everybody's looking at the same thing. So when you're in a bad drawdown, you got to figure that most of the other short sellers are in a bad drawdown as well. So what I find is that's actually the best time to size up. So leave some cushion in your size. Don't oversize to the point where you get in a drawdown, your account's already just about blown up, so now you can't size up when you're in the depth of that drawdown. So leave a little bit of a buffer there so that when things get really bad, you can actually size up, because a lot of times that's when the best opportunities happen. And we see that in COVID, for example. If you were leveraged, you lost all your money during COVID. And by the time you're at the bottom, you don't have any to buy back in. So pay attention to sizing so that you can take advantage of times when you're actually deep in a drawdown, you can size up appropriately to come back. Lastly, trading is kind of a lonely profession. I think that a lot of people lone wolf it. I'm kind of a lone wolf. My first quite a few years of my trading were lone wolf trading. I did it all myself, but I don't think we really have to do that. And I would like to see more traders connect and share their strategies so that they can create a more robust strategy between them. So with that, Richard, I think this has been super fun. So thanks for having me on. This has been great.
Yeah, my pleasure. And we'll drop your Twitter link down below so people can reach out, again, touch.
Sure.
But Ty, thank you so much again. Really enjoyed this one. A lot of fun. Like I said, made me think, which I appreciate. So thank you so much for your time. To everybody watching, I hope you guys enjoyed this as well. Leave a like down below. Again, touch it if you'd like, and subscribe if you haven't already. And we'll see you guys in the next one. Cheers.